Is Starbulk a buy or a sell? Let's get started with the model. This is a mid-cap company, 2.1 billion market cap. They're trading at $17 a share and they have 120 million shares outstanding. This company ships dry bulk cargo using its fleet of vessels. It transports a range of bulk commodities, including iron ore, minerals, grains, bauxite, fertilizers, and steel products. It has 116 dry bulk vessels with a combined carrying capacity of 13.1 million deadweight tons. It was incorporated in 2006, headquartered in Greece. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2022, 744 million. It went down nearly 60% into 2023, up 35%. It's a little over 400 million in the trailing 12 months. Really good margins, between 33% and 52%. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was 700 million in 2021. It has come down to 300 million in the trailing 12 months. Also pretty nice margins, between 18 and 48%. Revenue is a sales for the company, and that was good in 21 and 22. Then down 34% to 949 million in 2023, up 29% to 1.2 billion in the trailing 12 months. The reason people love this stock is the dividend, 14%, unbelievable. Whenever a company pays a really big dividend, you need to make sure they can cover the dividend, and they can cover it 1.5 times with their free cash flow. It cost them $289 million to pay the dividend, and they generate $430 million of free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's $6.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6 billion. We divide that by 120 million shares. And we got a calculated stock price of $50. They're trading at $17, so they're trading at a 65% discount. It's a really strong buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 99 companies in the same industry as Starbulk, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. It looks like they had a cash inflow in CapEx, because when CapEx is negative, that means they sold vessels. Their debt to equity ratio is equal to the median. For every dollar of equity, 60 cents of debt. They pay the biggest dividend by far, 14%. Nobody else is even double digits. They generate 400 million of free cash flow. Zim is the most at 2.6 billion. They rank 7th in market cap. Kirby is number 1 at 7.6 billion. Their price to book is equal to the median, 0.7. They're trading at 7 times earnings, which is normally a good multiple, but the median is 4.4. Look at Zim, 1.8. They have a great price to free cash flow. They're trading at below 5 times free cash flow. Price of sales is better than 2. They generate 1.2 billion of revenue. Zim is the highest, 7.5 billion. They're not really growing anymore. Their 5-year annual revenue growth rate is only 1%. Navios is number 1 at 44%. They're trading pretty close to their 52-week low. Actually, they're trading below their 52-week low. But it is trading 34% below its 52-week high. So it could be a good time to get in. Kirby is trading 1% below their 52-week high. The price is pretty close to 130. Zim is trading 220% above its 52-week low. That stock has done really well this year. If you put $10,000 into this company 10 years ago and reinvested the dividends, at one point you would have been down 90% after about a year and a half. But if you held on, you would have been in the green at one point. Currently, you'd be at $9,000, almost a 10% loss. To summarize, I have them trading at a 65% discount. I give them a ranking of 5 out of 10. It looks like it could be a good value. It's a really risky industry to invest in, very volatile. Would I buy it short term? 3 out of 10. Long term, maybe 5 out of 10. Ratios look pretty good, 7 out of 10. A really good price to free cash flow, even though it's worse than the median. Financials, 4 out of 10. All their numbers are down from 2021. They are up from 2023. If they continue this momentum in 2025, they should be able to beat their 2022 numbers. Let's take a look at their quarterly slides. Net profit of 81 million, EPS of 60 cents. This is for the third quarter of 2024. Look how much Voyage revenue is up. It was 220 million, now it's 344 million. The reason this industry is so volatile is because shipping rates move around a lot. Companies like this live and die by shipping rates. When supply of ships is higher than demand for ships, rates go down and revenue goes down, and so does their stock price. When demand for ships is higher than supply, then rates go up, their revenue goes up, and so does their stock price. It's a really volatile industry. So it looks like rates are coming back, at least when you compare this quarter to last year. Net income is nearly double last year. Operating cash flow is a little more than double. It was 67 million, now it's 138 million. EBITDA is up about 50%. They have 155 vessels, 34 more than last year. The rates are right here. Last year, the TCE rate, time charter equivalent rate, was $15,000. Now it's nearly $19,000. That's why they did so well this quarter. Operating expenses are also up, but not nearly as much as rates. OPEX is pretty flat. It goes up a little with inflation, but rates move around a lot. They're going to pay a 60-cent dividend, payable 12/18. So you want to own the stock, buy 12.5 to get that dividend. 3 months ago, they bought back 933,000 shares. At $21 per share, it cost them a little over $19 million. In total, they bought back 118 million shares. That cost them $29 million. Here are the rates they charge per vessel. The big ships, the Capesize and Newcastle Mac, $29,000. That's the daily rate. The post-Panamax, Kamsarmax, and Panamax vessels, $16,000. Ultramax and Supermax, $16,000. Here's their income statement, $344 million of revenue. Then they have a lot of expenses. Voyage expenses, $70 million. Operating expenses, $75 million. Depreciation, $44 million. So operating income, $98 million. Last year was $62 million. They spent $24 million of interest on their debt. So their net income is $81 million, up about 90% from last year. And they are adding shares. Last year they had 96 million shares. Now they have 117 million shares. But their EPS is going up. So adding shares is fine if your EPS goes up. If they added shares and their EPS went down, that's a problem. Here's their balance sheet. Total assets, $4.2 billion. Their main asset is the vessels. The cost of the vessels, $3.3 billion. Their main liability is debt, $1.1 billion of long-term debt. Their equity, which is assets minus liabilities, is $2.5 billion, up from last year of $1.7 billion. Their operating cash flow is $400 million. Operating cash flow is the cash the company generates from running its day-to-day business. They had a cash inflow from investing activities of $313 million. $250 million is from the sale of vessels. They received $104 million from the Eagle merger. Recently, they completed the merger with Eagle Bulk Shipping, and that merger added 52 vessels to their portfolio. In their financing section, they added $388 million of debt. The reason they added that debt was to pay down $375 million of Eagle debt, and they paid a lot of dividends, $206 million. Last year, $140 million. These numbers are for the trailing 9 months, so the last 3 quarters. Let's look at Starbulk on Simply Wall Street. Its last price, $17, $2 billion market cap, down 7% in the past week, down 21% in the past year. This looks like a picture of a cruise ship, not a cargo vessel. It started trading back in 2014, and right away it shot up to 77, its all-time high. It must have come down like 98%, because at one point it was below $2. And then it came down about 97% to below $2. That must have been a nightmare if you owned it in the 70s. And then over the next few years, it came up, then came back down. And then during COVID time, it was below 5. And then it had a really nice run up to over 30. That would have been a sweet ride from 5 to 30. It has not gotten to that level again. It did come all the way down to 17. Then ran up to 27. Now it's trading south of 20. Lots of volatility. It's a tough stock to own. Simply Wall Street's valuation is 51. They say the stock is 66% undervalued. 7 analysts priced this stock at 26. They say it's undervalued. Their free cash flow forecast for 2025 is $300 million, 2026 over $500 million. Their revenue was only $22 million in 2014. And then it ran up to $800 million, came down a little bit to below $700 million, And then the COVID boom to 1.7 billion. It came down about 40% to 950 million. Now it's at 1.2 billion. Their debt in 2013 was 190 million. It looks like the peak is about 1.6 billion. It's currently 1.3 billion. Usually their equity is higher than their debt. Now it's a lot higher. 2.5 billion of equity. Equity is cash. Equity is cash and also the value of the vessels. They have 450 million of cash, plenty to service the debt. Their next dividend is on 12/17. The ex-dividend date is 12/4. Their dividend in 2019 was 2%. It got up to 35% because the stock price crashed. Then they cut their dividend to a 6% yield, but it's been creeping back up there. The forecast is 16% for 2026. They did pay a 5-cent dividend in 2019, then eliminated the dividend. They brought it back in May 2021, 30 cents. In February 2022, it was $2. But you can see the dividend is all over the place because they pay out a percent of their profits. So if they're really profitable, like they were these quarters, the dividend's high. But if the profits are lower, the dividend's lower. 54% of the company is owned by the general public, 40% by institutions, 3% by insiders, and 2% by private companies. Brookfield, the Canadian real estate developer, is the biggest shareholder at 5%. The CEO owns 3.4%. Look at that name. I'm not going to even try to say it. Let me try. Rimar Shatari Runiti. Does anybody know if I got close to the actual pronunciation or did I butcher it? You got BlackRock, Marshall Wace, the Colony Group. Not too familiar with a lot of these names. Grand Alliance. Their employee count was 249 in 2013. Now it's 216. And the ticker trades on the NASDAQ and Deutsche Börse. If you want a free discounted cash flow model in Excel, watch this video and I'll show you how you can get it for free.